Have you noticed that even though the Federal Reserve has been cutting interest rates, mortgage rates have stayed roughly the same over the past 12 months? Here in Lancaster, we really haven't seen them drop, and today I'm going to explain why mortgage rates don't always move in lockstep with the Fed. So even though they were cut last week, we're going to see what really drives them and why it may take a little while for those rates to come down to a point where most of us want to jump in and buy. First of all, we have the Fed cut versus actual mortgage rates. A lot of people assume that when the Fed cuts rates, mortgage rates will instantly fall. But that's not how it actually works. You see, the Fed funds rate is a short-term rate that impacts things like credit cards, car loans, and home equity line of credits. A 30-year mortgage is actually a long-term loan product and is driven by a number of different factors. How do these rates get priced in the first place? Well, mortgage rates are tied to expectations, not just the announcements. So by the time the Fed actually ends up making the decision to drop the rates, investors, the bond market have usually priced it in already. That's why you may not notice the mortgage lender rates change the same day as Powell speaks, because the market has already adjusted because it knows that rate cut was going to be coming. The biggest driving factor of mortgage rates is actually the 10-year Treasury bond. Mortgage-backed securities are usually priced at a spread above that yield. So let's say they were 5%, they may be 5.5% to 6.5%. So if the 10-year rate stays high, that's why mortgage rates tend to stay at that higher number and haven't come down as quickly as we may have liked. Now, there are a number of other factors that come into play as well. Rates are also influenced by things like inflation, the strength of the jobs market, global events, and even the amount of debt being issued. Even if the economy is strong, inflation is sticky, or investors want higher rates, mortgage rates can actually stay elevated for a longer period of time. Unfortunately, what tends to happen is you want to have a bit of uncertainty in the market, and that will enable interest rates to come down. What's happened this year is that so far inflation has come down, but it hasn't come down to the target rate of 2%. We're also seeing the labor market, although it's weakening, is still fairly strong in the grand scheme of things, and investors are demanding a wider spread on mortgages because they want to get as much money as possible. That's why we've seen the Fed ease up a bit, but the mortgage rates are still hovering at somewhere between 5.75, maybe up to 7% in our Lancaster area. For rates to come down even further, we're going to need to see inflation continue to come down towards the Fed's 2% target. We need the job market to cool off a little bit, and the bond market needs to feel a little bit more confident. Only then are we going to see mortgage rates start to come down to anything meaningful. Now, are they going to come down to 4 or 5%? Unfortunately, it's unlikely we're going to see 4%. However, I have had a few clients get approved for FHA in the 5.5% range, and it also depends on whether you're willing to buy down your mortgage rate. The good news is the rates are definitely lower than they were at the start of the year. So for first-time home buyers who don't know any different, this is definitely good news. And for those of you who've been sitting on the equity in your home and maybe you're at a 2 or 3% interest rate, it does mean that that jump of going to the next home isn't going to be quite as painful as jumping up to a 7 or an 8% interest rate. Now, what I will say is if interest rates do continue to drop, we are going to see a lot more people re-enter the market, which could cause a bit more of a buying frenzy, especially in Lancaster, where we tend to have low inventory. What I'd also say is if you get in now, there's also a potential that if you do truly believe rates are going to drop, that you could always refinance at a later date. And again, even if you do refinance, because of interest rates coming down, more people can borrow more money, so you may find that your home is actually appreciated, and you may be able to get rid of things like mortgage insurance. If you've been on the fence about making that next move, make sure you click the link in the description below to connect with me for a client call. And if you are thinking about making a move into the Lancaster area, then click this video because this is going to be your ultimate guide to buying in Lancaster.